Managerial accounting, example 4D. Please read and be familiar with this example, and we will get started. So this is an example where a company has a product that is very popular, and we're not able to make all the units of the product that we could sell. So something is constraining us from being as profitable as we'd like to be. Now, no company has infinite profits, so every company has some kind of a constraint. If the constraint is marketing, then the company isn't going to sell as many units as it could produce. That's one kind of issue. But here we're going to deal with a situation where the constraint is internal. Marketing is doing fine, and the constraint is something else. So in this case, there's an ingredient, a direct material that we don't have sufficient quantity of. The issue here is when we have a constraint, we want to make the most profitable use of the constraint possible. And accounting doesn't often tell us what the profitable use of our inputs is. Accounting is generally intended to give us the cost and the revenue per unit of output, but it doesn't always ask or instantly reveal questions about the profitability of the use of inputs. So that's what we need to do. We need to adjust our accounting to answer the right question for the problem that we're facing. So in this setting, we've got 3 different products with a projected demand in units. And if we were to do all the math and figure out how many how many milliliters of pepper we would need to fulfill all of the demand, we'd find out that we need more than 2,500 milliliters of pepper, which is what's going to be available for our product. So we do have to make some decisions about which products to make. And what we do need to do is maximize the profitability of the use of our inputs. So requirement 1 asks for the most profitable use of our limited supply of pepper. A couple things to recognize here. Again, the problem is an internal constraint. Marketing is fine, demand is strong, and the constraint is internal. Second of all, we need to understand what profitability means in this setting. This is generally going to be sort of a short-term kind of setting, and the amount of fixed overhead that we have, or any kind of fixed cost that we have for our products, is not going to vary based on the production decision that we make. In other words, in the short run, we're not going to have more or fewer fixed costs based on whether we're making the 1-ounce product, the 2-ounce product, or the 4-ounce product. All we need to worry about is those things that do vary with respect to the numbers of particular products that we make. So we have to worry about the selling price and the variable cost, and therefore the contribution per unit, but we don't need to worry about the fixed overhead allocated. And this idea of a profit per unit is really going to be misleading because it takes our contribution margin and subtracts a fixed cost per unit. Now, there are going to be lots of settings where you're going to have a product margin or some kind of a profitability per unit, but if it includes fixed costs, it's not going to be relevant for most of your short-term decisions. The other thing we have to consider, once we know that we can ignore our fixed overhead costs and this profit per unit number, we do have to consider how many milliliters of pepper or how much quantity of the input each product uses. So the decision model we have to use is our relevant measure of profitability, which is contribution margin. But instead of reporting it on a per unit basis, we have to report it on the milliliters of pepper, or more broadly, the contribution margin per unit of the constraint. Remember, the constraint is something that we have to try to exploit as best as possible and use as profitably as possible. So what we're going to do is we're going to take our contribution margin and divide it by how much pepper is going to be used in each product. And so what this tells us is if I take a milliliter of pepper and I put it into a 1-ounce product, I'm ultimately going to generate $10.17 of contribution margin per milliliter I put into that product. For the 2-ounce product, I'm going to generate $5.93 of contribution. For the 4-ounce product, $4.66. So what this tells us is that per unit of our input, the 1-ounce product is the most profitable, which is different from the answer you'd get if you looked at the products on a per unit of output basis. Our 4-ounce product has the highest contribution margin per unit, $11 versus $7 or $6. So if I had a choice of selling which unit, of course I'd rather sell the 4-ounce unit than the 2-ounce or the 1-ounce because one unit generates me more contribution margin. If we look at this misleading profit per unit number, because we have distortions in how our fixed overhead is allocated, this number is not going to be terribly useful anyway. But this number would tell us that the 2-ounce product would be the most profitable based on the way our overhead's allocated. But again, changes in what we make on a short-term basis won't affect our fixed costs, so we can ignore these last two rows. So again, the relevant measure of profitability is contribution margin, but it's contribution per unit of input. So what this tells us is if I've got pepper, I want to most use it on the 1-ounce product because that's where I'm going to get the most profitability. Once I fulfill all the demand for the 1-ounce product, I'm going to make the 2-ounce products until I fulfill demand for those. And then finally for the 4-ounce product, I'll use whatever remaining pepper I have left to fulfill that demand. So this is the order in which we're going to produce our products. So we're going to produce the 1-ounce product first, the 2-ounce product second, and the 4-ounce product third. Now, in a different scenario, it could be the case that you only have enough of the raw material to produce one of the products at all, or maybe only two. You'll have to do the math and figure out whether you can produce all three. So now that we know which order to produce them, first the 1-ounce, second the 2-ounce, finally the 4-ounce product, how many units of each product should we make in order to maximize profits? We know the order, now we've got to schedule the actual production. So here's where we sort of have to do a bit of an extended math problem just to keep track of how many milliliters we have. So we're told we have 2,500 milliliters of pepper available. The first product we're going to make is the 1-ounce product. We've got demand of 1,000 units. And the milliliters per unit is 0.59 milliliters per unit. So the total milliliters demanded would be 590 milliliters. So if we make all 1,000 units that we believe the market's willing to buy, then we're going to use the first 590 milliliters demanded, and then the milliliters remaining is going to be 1,910. So then we can move on to our next product, the second most profitable use of our input, which is a 2-ounce product. Our demand for that product is 800 units. The milliliters per unit is 1.18 milliliters per unit. And so the total milliliters demanded will be 944. Do we have enough pepper available to make all those products? We do. So we can go ahead and make all 800 of the 2-ounce product. And then finally we can go to the 4-ounce product. Demand is 500 units. The milliliters per unit, 2.36 milliliters. So the total milliliters demanded, oops, I forgot to add one row here. After we make all of the 2-ounce product, we'll only have 966 milliliters remaining. To make the entire 500 unit demand for the 4-ounce product, we don't have enough milliliters for that. So we can say for the milliliters available for use is 966. We're going to take the 966 milliliters remaining, divide that by the 2.36 milliliters per unit, and so that tells us we can produce about 409 units of the 4-ounce product. So we're going to produce 409 of those, 800 of the 2-ounce product, and 1,000 of the 1-ounce product. And there's not a production schedule that meets our demand requirements and the demand constraints and meets the 2,500 milliliters of pepper spray that will generate a greater contribution margin for us than this particular demand schedule. So this is how we go about maximizing the use of a constrained resource. We want to maximize the contribution margin per unit of the constrained resource. Finally, if Safekeeper has the opportunity to buy more of its pepper spray at a premium price, what's the maximum premium it should pay? Really, the maximum premium it should pay is the amount of contribution margin it makes when it buys a milliliter of the pepper. So it's going to depend on which products we're making. In this case, if we need to buy extra, it's because we're making the 4-ounce product. And for every milliliter of pepper we put into the 4-ounce product, we make $4.66 worth of contribution margin. So in that case, because that's the product we're making, the most profit we can make is $4.66. So the premium that I should be willing to pay to buy additional milliliters of pepper is $4.66 per milliliter. If it were the case that I were making the 2-ounce product, I'd be willing to pay up to $5.93. And if I were making the 1-ounce product, I'd be willing to pay a premium of up to $10.17. Obviously, we'd prefer to pay less, but this is our decision point as to whether the additional cost is worth it or not.